Tonight my task is to convince you all that property is a superior asset to accumulate wealth over the long term. But before we enter this discussion and I mount my argument in favour of property, it's important that we firstly define what property is. In its simple form, property is land and any buildings or structures on it. It generally falls within two categories, being residential and commercial, which in itself comprises office, industrial and retail property. So firstly, residential, of which most of you are probably familiar with, basically consists of houses, units, apartments and townhouses, and generally provides an income rental return of between 3 and 4.5%, depending on the stage of the property cycle. It's also quite often that the lease terms are shorter term in nature, between 6 and 12 months. So moving on to commercial property, we'll start with office, which is essentially a building used for business purposes. The rental returns from this type of property are generally higher than residential and generally range between 6.5% and 8%. One of the more unique properties is industrial, in that it's quite often specifically constructed or built for a particular business or industry, and it's because of this particular reason that the rental returns are the highest of any property type and generally range between 8 and 10%. In addition to that, the lease terms quite regularly exceed 10 years. And finally, retail property, which is effectively regional or sub-regional shopping centres. They're basically buildings used to provide goods and services to the public. So when we make a comparison between the rental returns from each of those property types, you can quite clearly see that the commercial space, which comprises office, industrial and retail, generally provides a higher income return than residential. And it's really because of this particular reason that commercial properties primarily viewed as an income producing asset. So although it does provide capital growth over a long period of time, it's usually the income return that exceeds that capital growth. So looking at a comparison between residential and commercial property, one of the main differences between the two is that commercial property is ultimately valued based on the quality of the income that it produces, the quality of the lease, and the quality of the tenant. On top of that, it generally provides regular increases in rent, and the tenant usually pays a lot of the outgoings. Now we compare that to residential property, which is basically viewed, or primarily viewed as a capital growth asset. The rental returns are often quite lower than the capital growth that the investor would receive. Likewise, as some of you may know who have invested in residential property, it's usually the landlord who cops a lot of the outgoings. As far as entry into the particular market, it's quite often that commercial property, if we're looking at it at the quality end of the market, usually entry costs are somewhat higher than residential property. So what are the drivers of performance? Well, like most assets and commodities, one of the key drivers of performance of property is demand and supply, which from a property perspective is ultimately driven by location. So what that fundamentally means is that if you have a location which is obviously limited in supply and there's excessive demand for that particular location, the price of that property will be driven up until there's a market price reached. On the economic front, a significant influence on demand and supply, as John touched on earlier, is interest rates, and that does have a significant impact on property prices. Now, there's no better example of looking at this relationship than the following chart, where we have the interest rates represented by the red line and the property market in capital cities represented by the blue line. So you can quite clearly see here that there's an inverse relationship between these two factors. So starting in the late 1990s, you'll notice that as interest rates started to fall, the property market began quite a significant upswing in its values, which ultimately led to what we now know as the property boom. Now that came to somewhat of a halt around 2005, 2006, when interest rates started to rise, and ultimately had another upswing at the height of the GFC when interest rates fell quite considerably. So you can really see that relationship between interest rates and property prices, and as we've seen recently, with rates rising again, property markets have stabilised and come off in some areas. So why invest in property? Well, one of the major strengths of property is that it's solid bricks and mortar. You can see it and you can touch it. So really, regardless of the short-term movements in the values of that particular property, it'll always be there. You compare that with shares, which are obviously a more complex investment, but also once their value is effectively worth zero, that fund can be lost forever. Investors understand property. Most people have bought a property, sold a property, rented a property, or at least lived in a property at some stage during their life. So really, in that regard, even the most lay investor understands the basic principles of property investment. It's pretty simple. You buy a property, you get a tenant, you receive rent. It really doesn't get much simpler than that. Once again, we compare that with shares, which are obviously a more complex financial instrument. Now, even Warren Buffett, the most famous share investor in the world, quoted, "If we can't find things within our circle of competence, we don't expand the circle." Now, what that fundamentally means is that we do what we know and only what we know from an economic perspective or from an investment perspective. And for most people, that's property investment. Property provides a natural inflation hedge, so unless we have a reversal of climate change and sea levels start falling, or we start building out into the ocean like Dubai's Palm Island, there's only a limited supply of land. And I love this quote from Mark Twain, who was an American author and comedian in the late 1800s. "Buy land, they're not making any more of it." It really makes sense. Property is less volatile than shares. As we see on a day-to-day basis on the news and through the newspapers, share prices fluctuate quite considerably on a day-to-day basis, and there's really been no better example than in the last 2 to 3 years with the global financial crisis, where markets, in particular the share market, has been extremely volatile, and we've seen significant downward movements in their prices. However, during the same period, properties provided a more stable return and in fact increased. So this following chart here, which once again shows shares by the green line and average house prices via the red line, you can see how volatile shares have been over that 23-year period, whilst over the same period, property has provided a more stable upward return. Property values grow over time as population and urban footprint grows. And once again, via a chart, we can see here where we have population growth rates via the purple line and the property price growth rates via the broken blue line. You can see there's a positive relationship. So what that's basically showing us is that so long as there's positive population growth, there'll always be increases in property prices. And the one final point I'll make in regards to why to invest in property, well, banks lend more against property. Now, this provides a significant opportunity to leverage investment returns and magnify the growth of your assets over time. And I'll expand on this point in a few moments via a case study. So getting down to the nitty-gritty as far as comparing returns between these two asset classes, what I've provided here is the returns not only of shares and property, but also of every other asset class over a 15 and 10-year period. Now, it's pretty clear here that property has outperformed not only shares, but every other asset class over the same period of time. So moving into a case study where we can look at how property can be used to accelerate the wealth creation over time. In this particular example, we have Bill and Jane, who own a property worth $1 million. They've got an outstanding mortgage of $600,000. As you can see, they built up a fair bit of equity in the property. So they're quite keen to establish a wealth creation strategy, and they're also comfortable borrowing for investment purposes. But they really don't want to have their loans exceed 80% of the value of their property. So in that particular instance, they've got two options. The first option is they can borrow $200,000 to invest in a portfolio of shares, or they can utilise $200,000 of their residence, so borrow $200,000 secured against their residence, and because they're buying another investment property, the banks will lend them another 80% secured against the investment property. So what that basically means is, by utilising their residence as security, they're effectively able to borrow 100% of the value of their investment property. So in this particular example, what I'm assuming is the same investment return. So we're really looking at the leveraging benefits of investing in property versus shares. So the investment return is the same at 10% per annum, and the interest cost is 7.5%. So via this chart, where we've got the net property value after 10 years and the net share portfolio after 10 years, it's pretty clear here that property significantly outperforms shares purely because the banks have been able to, or have been willing to lend you more money because it's obviously solid bricks and mortar, and it's enabled you to further magnify your return. So in this particular example, the investors are better off by about $350,000 investing in property than by investing in shares. So really, in order for shares to break even in that particular example where they've got the different leveraging amounts or the different borrowing amounts, shares would have to return 16.5% per annum to break even with that property example. So it's a 65% greater return to reach the same level. So to summarise, different types of property provide exposure to different assets, which effectively enables you to diversify your exposure and therefore reduce your investment risk. Demand and supply together with interest rates are the ultimate driver of property prices. Property is a tangible asset that's simple to understand. Property provides a natural hedge against inflation and increases value as populations grow. Banks prefer property, which provides the opportunity to leverage returns, as we showed via that case study. And finally, as the results show, properties outperformed every other asset class over a 10 and 15-year period. So on that note, I'll pass over to my colleague Andrew Hewison, who will mount the argument in favour of shares.